Hi friends, welcome to part 4 in our 6-part video series that we've been going through on hidden investor risks. Or said another way, risks that exist whether investors know that they do or not, and how it might negatively impact you. And so today what we want to talk about is the dividend disaster. Many folks, especially in this environment, are concerned about yield or dividend chasing. We need to own dividend producing assets, and that's stated and articulated in lots of different ways. Oftentimes what individuals mean when they say that is, can we own investments that have the highest rate of distribution? And there's lots of problems embedded in that with what kind of quality, what kind of sustainability of the cash flow. But let's just step back from that for a second and talk about the way that the IRS treats your dividends. So I hold right here a 1040, the first page of a tax return. And if you were to go to your tax return and as of 2021, scroll down to line 3A and 3B, you'll notice line 3A is qualified dividends and line 3B is ordinary dividends. What's the difference? The IRS says that there are fundamentally two differences in distinguishing a qualified dividend and an ordinary dividend, and the tax rates for both are far different. A qualified dividend has to do with the amount of time that you hold the investment throughout the year and around the dividend date. And number two, the company has to be a domestic corporation, meaning where they derive their revenues from is based in the US, or at least predominantly, not exclusively, but predominantly. Ordinary dividends are any corporations that derive their investments and revenue primarily from the US, but you don't hold for the appropriate amount of time throughout the year. So you could own a company that produces a qualified dividend, but if you don't hold it at the right time, in the right way, for the right length of time, then it becomes an ordinary dividend. Other institutions that produce dividends are things like oftentimes master limited partnerships. And those are oil and gas primarily companies, pipeline companies oftentimes. Real estate investment trusts, which oftentimes have high rates of distribution. Banks, interest rates, and other things. So a qualified dividend versus an ordinary dividend. One is taxed at the standard 15% rate. Now there are certain occasions where you can actually pay 0% on a qualified dividend, and there are other occasions where you'd pay a 20%. But for most tax filers and in most cases, the qualified dividend rate is 15%. What's the ordinary dividend rate? It's your regular income tax rate. So if you've got somebody in the 32% federal tax bracket and they have a dividend from an ordinary dividend investment structure, they pay 32% on that income. Whereas somebody who owned a qualified dividend investment pays 15%. And the numbers can actually be substantially higher. If you're in the highest tax bracket and you are paying 37% on your rates on ordinary dividends versus 15% potentially, or 20%. So what you ought to be asking is a couple of things. Number one, what kind of dividend investments do I own? Number two, is there a way for me, without changing my investments, to lower my liabilities on those dividends? And number three is, how do I know? How do I know that I own the right companies or the right dividend producing assets in the right accounts? Because that's the other element. It's not just that ordinary dividends and qualified dividends are taxed differently, because they are, but there's certain accounts that you should own each of those in. Let me give you an example. If you have an investment that pays an ordinary dividend, we already know that's the highest tax dividend possible, and you've got an investment that owns a qualified dividend, wouldn't it make more sense for you to own your highest taxed investment dividend in an account where you're not taxed on it, Roth IRA, or tax deferred on it, IRA and 401k? Now the contrary is also true. Wouldn't it make little sense to own qualified dividends, which are the lowest taxed dividends, in accounts where you don't benefit from. So this goes back to something we touched on in part 2, which is asset location. What you own is important, but where you own it might make all the difference in the world. So if I tell you there are 2 investments, one pays a 5% and one pays a 4% cash flow, which one's better? You don't have enough information yet. Because if it's a 5% at an ordinary dividend or a 4% at a qualified, you should take the 4% most of the time because it's more advantageous. And so one of the things that we've done with clients and that we've done with friends and family members of our clients is we've got a proprietary process to work through classifying all of your investments. How are they treated from a dividend perspective? And what transitions or movements could you make that would not have a negative impact on you, but actually decrease your liability for tax purposes on your dividends? This is an exercise we do with families all the time. And if you're not a client of ours and you'd like us to help you with that, we're happy to work directly with your CPA or your tax advisor and to provide for you in written form. Here's how the IRS treats these dividends, and here's how some changes that could be made that might be advantageous for you, because we all know at the end of the day, it's not about how much you make, but it's always about how much that you keep. Thanks for watching part 4. Part 5 in our 6-part video series coming next. See you next time.